Diversify the what or diversify the where? Because it
Both.
is different.
Both. I think diversification in terms of style, so think about value as well as growth, and diversification in terms of region as well. Think about the rest of the world as well as the US.
Because region right now, I'd get excited about South Korea. I'd be diversifying the where, but not the what. What are you interested in beyond just the AI tech trade?
Well, South Korea is a couple of stocks, not a region. So look, I think, first of all, the tech trade itself, you can't ignore it, obviously, and you can't just dismiss it. And yes, we see these warning signs. One of my portfolio managers told me she was called by her college-age son and asked about last week, is it a good time to start buying memory stocks? You know, you see incredible interest in these ETFs booming. Those are things that worry those of us that have been around for a long time, but when you look at the fundamentals, they're incredibly strong. And history tells us that these kind of moves go on until, first of all, things get expensive. Secondly, volatility starts to pick up. That's a real warning sign. And thirdly, the earnings revisions peak. That's when you've got to really watch out. And that's not yet what we're seeing when it comes to semiconductors. So on the valuations, sure, on things like price to book, price to sales, multiples are getting up there, but the earnings multiples are still, for many of these stocks, still single digit. And that's true in the US, it's true in the rest of the world as well. So a mixed picture there. Volatility absolutely going up. You're getting enormous moves every day in both directions. That's a warning sign. Earnings momentum doesn't seem like it's peaking. You just mentioned Cisco. Every data point we've seen in the last few weeks just fuels the fire. Things are getting better, driven, of course, by, at the root cause of it, the frontier models inflecting, hyperscaler investment going up every time you look at the numbers. That trend hasn't yet changed.
Just to add to your fear, my 17-year-old son came to me on Tuesday after the 0.7% drop and said, I bought the dip. And I said, oh, dear Lord. But to that point, you know, how do you diversify from something that is profoundly existential and rooted through every valuation of every company? It's rooted in the bond market. It's rooted on growth expectations and productivity. What does it mean to move away from that when it seems to be increasingly embedded in people's economic and financial expectations?
Sure. Well, I'll give you an example. So we've seen investors looking a lot at international value strategies in the last couple of years. So international value is diversifying about as far away from technology and Magnificent Seven as you can get, right? So it's geographic diversification and it's style diversification. And you can look at you can put together a portfolio of international value stocks, pay around 11 times earnings. They're decent companies. They're not growing that fast. Tech is it's something like 3 or 4% of that type of portfolio. And you haven't had to sacrifice returns. So you've made 40% in the last 12 months from international value, 25% type compound return over the last 3 years. It's actually significantly better than the S&P. Now, I don't think that's a realistic expectation looking forward because the starting point is higher now. But the point is there are other ways to make money in world stock markets. Our research team covers 2,500 companies, and not every one of them, their entire fate rests on AI.
How much is it a corporate story and how much is it an FX story at a time when a lot of people are expecting the dollar to weaken?
The dollar weakening, we tend to sort of look at the world bottom-up, company by company, so I always prefer to get excited about the corporate story rather than relying on the currencies. But yeah, currencies played into that a little bit. But no, it's been much more a corporate story. So for example, the European banks went from uninvestable to solid companies. You made 5 or 6 times your money in a few years. Energy stocks, written off a year ago, now their earnings are booming. So there are just other ways to make money in global stock markets. And I think it's at a time like this when all the attention is in one place, it's really worth remembering that.
Can I throw another asset class at you? Started with FX. I want to throw bonds at you as well. Fixed income feels a little bit untethered right now. Looking at Japan, yield levels we haven't seen since some maturities started in the late 1990s. In Germany, at any given time, yield levels we haven't seen since 2011. You've seen the stats coming out of the gilt market in the UK, highs of the year, stateside. What do you think is developing in there? And is that a challenge to your asset class in the equity market?
Well, we have enough challenge keeping up the 2,500 companies that we're looking at without worrying too much about what's going on in the bond markets too. But we have to be aware of it. I'm old enough to remember the crash of '87 when no one cared about bond yields until they did. That was 6 months into my career as a portfolio manager. So that was a learning lesson right there. Look, we're a long way from that kind of extreme, right? So, but what we do, our observation about the economy is when we look at earnings and corporate profitability, it's incredibly strong, but it's very concentrated. So we're going to see earnings in the US this year up mid-20s now, our analyst estimates. That's up 4 or 5 points from where it was just a few weeks ago. And yes, it's broadening beyond the Magnificent Seven.
Yeah.
So the 493 are going to be up close to 20% this year. but it's still tech. So if you take tech out, and also energy, which is obviously something different as well, you've got around 8% earnings growth. So that's okay, but that's not a boom. The boom is AI. So from a bottom-up point of view, the economy looks okay, reasonably strong, but all the excitement, all the inflationary pressure, it's in the AI space.
Your asset class, though, is in a competition for flows. If I can sort of boil it down to that, you've identified a problem, concentration. I'm identifying an asset class that's offering some real income now in a way that it hasn't for a number of years, in any given place, in any given time. And I'm trying to understand whether you would see that as a reflection of a better profile for growth looking out, yields higher, curve steeper, or whether you see that as competition for flows that would otherwise go into your asset class because of the concentration risk.
Yeah, sure. There is a little more competition, right? It wasn't hard to choose between stocks and bonds when bonds were yielding 2%. We went through this long period after GFC in which bond yields were just incredibly low by any kind of historic standard, and it was kind of hard to get too excited about bonds back then. We've gone from extremely low to what our fixed income team think of more sort of normal, typical levels, so it's fine. It's not yet in the competition stage.
We've seen incredible returns, double-digit returns for a number of years now, and people are wondering whether we're entering a time of more tempered returns. Are you expecting to prepare your clients for more 8 to 10% returns on a forward-looking basis versus, the 20-some-odd% that we've seen recently?
Yes. I think that's very reasonable. So why such great returns? Obviously, fantastic earnings growth. We think that's going to continue, but at a slightly slower pace. So as we think about the next 5 years, our analysts get to around 10, 11% earnings growth a year for the S&P 500 companies. That's pretty good, but it's not 25% we're getting this year. So, and then on top of that, multiples, they've been going up at a modest rate. They're at the kind of high end of the range. That doesn't terrify us. But it's hard to imagine multiples going up a lot and building that in as part of your returns. S&P's trading around 21 times. We would think something like 18, 19 times. So it's a little bit high. It's not crazy, but I wouldn't build in from here multiple expansion. So it's all about earnings. It sort of always is, but even more so than ever when you're starting at, paying a pretty high price.
I was trying to